Hey everybody, this is Brant from Wolf on Wall Street Trade with the market update for the week ending March 13th, 2020. Another historic week. The Dow Jones Industrial Average crashed into a bear market. Its 11-year bull market ended this week, and it did that at one of the fastest paces in history. Average bull market, here is the 2020 sell-off. There are only 3 times in history that we had an event more dramatic than this. 1914 was one, 1929, 1987. Here is 2020. And we had 2 days that were limit down and 1 day that was limit up. Lots of global intervention. Last week we saw the Fed do an emergency rate cut. This week they had another emergency operation to boost liquidity in term repos, bringing it up to $5 trillion a month, possibly $5 trillion a month, $1.5 trillion in additional repo, and QE4 is officially underway. There are some liquidity problems manifesting in the market, and that can be seen in the treasury market. People are having a hard time even trading a treasury, one of the most liquid markets in the world, and there are credit problems developing. So this week we saw Boeing draw down a $14 billion revolving credit line. Hilton Hotels was set to do the same. I think Blackstone was advising clients to do the same. So if you remember the financial crisis in 2008, you might remember, if you had like a home equity line, a HELOC, that my neighbors were saying, oh, the bank just shut down my home equity line, and then people were rushing to get that money out. So that's what the corporations are doing right now. They're afraid that the banks may withdraw their credit limits. What really got things underway on the downside is that the OPEC plus Russia meeting failed, and Saudi Arabia essentially started a crude oil price war. So here's the S&P 500. It's down 8.8% on the week, the worst week since October of 2008 in the midst of the financial crisis, and the best day on Friday since October 28, 2008. We'll go back and take a look at that in a minute. Here is the Dow, down 10.4% this week, wiped out about 2 years and 9 months of gains in 3 weeks. Let me just zoom this out. December 2018 low, blasted through that. I mean, look, just wiped out almost 3 years of gains in 3 weeks. Small caps, I have IWM here, down 17.25% on the week. It's the worst 3-week crash in small caps ever, down 35%. Here's a weekly chart of the NYSE, traded below the 2007 highs and retraced all gains since President Trump was elected. I just mentioned S&P worst week since October 2008. Here's October 2008, and Friday the best day since October 28, 2008. So we're going to zoom in on that, take a closer look. So that was the day that TARP was announced. You can see the Fed had been cutting rates, emergency rate cuts before that. And you can see we got a pretty good bounce on that. So we might be in a situation like that this week, and I'll show you this upcoming week, and I'll show you why. But from this point, ended up losing about another 35%. And this is like in the depth of the financial crisis, just to give you a little more perspective. So this is towards the tail end of the financial crisis. So last week I said that I thought this was just a first leg down. Sunday night I put out targets for my members. Actually, even before we got to Sunday night, I said I think we have like about another 15% to go. But Sunday night, before the market opened over here, I put out targets for all the major averages for my subscribers at Wolf on Wall Street Trade. So here's the S&P 500, the Dow down here, and I gave them for NASDAQ and small caps too. So let's take a look. This is a 15-minute chart of the S&P 500, and this is basically the whole sell-off. So let me put in some trend lines, and I'll show you what I'm talking about. So here's the first leg down, and this is the bear flag I was talking about in last week's video. This is kind of how we ended the week, and this is how I came up with my targets. So my target is right down here, 25.20. I adjusted it a little bit on Wednesday after we got this bear flag. I think I moved it down by about 1%. These measured moves are coming in pretty much right on the nose. Here's the Dow, 21,200. And again, this is from Sunday night. And I revised that target a little bit on Wednesday. So here's the original at 21,200. I moved it up to 21,400. As you can see, price hit both of them and pretty much stopped there and consolidated for the last 2 days of the week. NASDAQ, same thing. One big measured move down. Here's the second, but it came in 2 smaller legs. So that's why I adjusted this target, 72.40. This is where I cleaned up the rest of my shorts. I had like little pieces of shorts left over because I usually get out of like 75% of a position and leave a little on. So I had some shorts in NASDAQ and semiconductors. I got out right here because all the other averages hit the target, And towards the end of the day, right at the close, it actually hit that target 72.40 where I intended to close it. And here's small caps, IWM, with the target at 112.50, but there is a difference on this one. Small caps actually have 3 legs lower, 3 distinct legs. So when the market consolidated here in the middle of the week, a very small consolidation, bear flag, small caps kept making lower highs and lower lows. So this is actually 3 legs lower. By Tuesday or Wednesday, I can't remember which one, I put out targets for all 11 S&P sectors. Here's materials, first leg down, bear flag, second leg down with a small bear flag between. There's the target. I'm just going to run through these quick. XLE, the energy sector. Now this is another one that is 3 legs down like small caps. 1 here, 2 here, 3rd here. And remember, this is where the crude oil price war started this week. So they gapped down bad on Monday. Here's the financial sector. This is an interesting one too because financials have gotten beaten up bad. 1 leg, 2 legs, 3 legs, just like small caps, but has not hit the downside target yet. One of the few sectors that hasn't. Here's that downside target for XLF, which is around 1975. So from Friday's close anyway, it's about another 14.5% down, 15% down in that area. 3 distinct legs. These are the areas that have been beaten up the most. Like small caps, they all have 3 legs down instead of 2. The industrial sector, 2 legs down, traded through the downside target and then settled right at it. Dow Transport's another area beaten up bad, another one with 3 legs, and it fell just short of this target, had a consolidation on Friday, and then we got this end of day ramp in everything on Friday. So from Friday's close up here, that's about 10.5% to meet that target. Here's the technology sector, 1 leg bear flag. Here's the second leg. I had 2 different targets just because of how this decline started. In any case, you can see that the buy the dip crowd is getting less and less confident. You see how steep this first flag is? The next one is not as steep, and then this one's even flatter. So the buy the dip crowd is losing their confidence as they keep getting run over. Consumer staples, 2 legs down, hit the target almost exactly. Utilities, same deal. There's the target. You can see 1 leg, bear flag, second leg. Healthcare, hit the target very briefly. And here is consumer discretionary. There's the target zone. And the communications sector. This was the original target zone. It was modified lower after I saw this first flag develop this week. And here's the real estate sector. There's the target. Blasted through it on Thursday morning and settled up around it. So like I was warning, last week, be very careful with indicators. They're not built for this kind of volatility. And people can't interpret them when they're used to a certain low volatility for 10 years and then something like this comes up. They will give you oversold signals all the way down. Eventually, they will be right at the bottom, but you'll get false signals along the way down. When we get price volatility like this, it's not being smothered by volatility suppression by central banks. I rely first and foremost on price action. So with that being said, all these second leg targets have been hit, and in IWM's case, the 3rd leg target has been hit. So there's only a couple sectors out there that haven't hit them. So the bank index is one, and you can see it had a bear flag on Thursday and Friday, even though closed up stronger, and that target is a bit lower here, down here around 60. So from Friday's close, that's roughly almost 20%, still a big drop. And then of course, because they're in the financial sector, financials, and then as I mentioned just a moment ago, Dow Transports. To me, they're kind of close enough, and everything else hit those targets. That's why I took off my remaining shorts and went flat. VIX up 38% for the week, and from where we got this ABI buy signal down here at 12, VIX is up over 500%. So I caught the first leg of this and got out, and wow, am I regretting that. So this is also the highest level since the financial crisis. Here it is on a 6-day chart. There's the financial crisis. So extreme volatility. Here's VVIX, the volatility of VIX. I always say, above 110 is the red zone. That's like put on your crash helmet, get under the desk. Hit 180 this week. So let's take a look at it on a intraday chart. Here's the trend for the week. Until these kind of volatility trends break and volatility comes down, expect 1,000-point moves, 2,000-point moves to be the norm in the Dow. Here on Thursday, we had a day that was down 2,350 points. The next day, up 1,985 points. So what happens is on CNBC, when the market's down, everybody is bearish. And then one day when the market's up, they get super bullish. It's like the bottom's in, let's buy everything. So what I'm saying is follow the trend, not what the market did on the day as far as, price percent gain or point percent gain or losses. Follow the price trend. And in terms of the price trend, you can see it is lower lows, lower highs. So it is bearish price action. All I can really say is that most sectors and most averages, almost all averages, have hit what I would expect for the measured moves. Friday, we had a real strong close. You can see it over here as President Trump was speaking. I think really right when he said Google was developing a website for the coronavirus, but it came out afterward that this was only for the Bay Area, not nationwide. So we'll see what's given back on that. But we also had the House of Representatives pass a bill, and that will include enhanced testing or more testing. And that's really what the market has been missing, is visibility. So would this be a good place to correct from, to bounce from? Yes, I think it would be. But in terms of price action, it's still a bearish trend. Bearish flags did get that stronger close on Friday. This may be a wider flag, or maybe it's a start of a correction. Either way, what we know right now is that we still have a pretty bearish trend. In terms of market breadth, this is the S&P 500 daily chart, and this is the count of NYSE new lows. They have been going up as the market's been coming down. Ideally, what you want to see is the market come down and test a low, and you want to see these new lows come down. And to see that, you'll have to see small caps put in better relative performance. Thus far, small caps have been leading to the downside, have had very weak relative performance. I'll show you one other thing real quick. Let me back this chart up a little bit. Okay, so here's the 2018 low into 2019, the big rally we had. You can see the new lows over here just soared, right? So let me move this forward a little bit so the scaling looks better. Into 2019, as we rallied, as we're making lows, either equal lows or higher lows, we're seeing new lows increase. When we get a pullback like this, new lows should be less than the prior pivot low, like over here or over here. This was a big warning sign, and what that means is that when these price levels get tested, eventually they're likely to break. And you can see, even as we made higher lows in price, we had more new lows going up. This is market breadth deteriorating, getting weak. And one of the most obvious places you can see that is the fact that small caps did not confirm the S&P, the Dow, the NASDAQ. They did not make a higher high. Of course, nobody cared about this at the time. They do now, because this was a warning sign, and people will look at this market in retrospect and say, wow, there's that big warning sign there the whole time. But, like this other chart, people don't care at the time. So let me show you what's happened so far. Keep an eye on these levels over here for the S&P 500. Crashed right through them. And now, if you look how high the new lows are, the new 52-week lows, relative to back here at the December 2018 crash, we have a higher price low, but we have more stocks making new lows. That says that when we get down to this level and test it, maybe not the first time, but eventually it is likely to fail. And we have seen that failure in small caps. We've seen that failure in the NYSE. We've even seen that failure in the Dow. The S&P 500 is still above, and the NASDAQ 100 is still well above. You may recall last week I was saying the Dow transports are well below that level, and they've lost more this week, of course, and that suggested that the Dow was going to do the same. So this past week, that's what the Dow did. Take a quick look at some shorter-term breadth indicators, the NASDAQ 100 in the candlesticks, and this is the 13-week new high, new low ratio. So you can see it's down here around 0, and this is something I was warning about with pretty much all indicators, especially oscillators, is that they're going to give you really oversold levels. Below 40 has been an oversold level for this market the last several years. We're down here at like 0. We saw the same thing in December of 2008. Down here at 0 for 12 days. So we've got almost 3 weeks with just a brief pause as this bear flag formed at 0. So yes, extremely oversold, but you have to be very careful with these indicators because they will tell you you're oversold on the whole way down. They're eventually going to be right. So here's a 15-minute chart of the NASDAQ 100, and this is the NASDAQ Composites Advanced Decline line in white. This has been really helpful to me. So we had this bear flag, and we started breaking it last Friday. And what I noticed was if you look at this prior low, price over here is well above it. But if you look at the advanced decline line, the low over here, it was already leading lower. Okay, and we got the exact same thing over here when we got a little consolidation this week. If you looked at where price was and you looked at where the advanced decline line was, it was leading prices lower. So this has been helpful. Now notice I'm using the NASDAQ Composite Advanced Decline Line, not the NASDAQ 100. It's kind of the same. I would use NYSE's Advanced Decline Line too over the NASDAQ 100 because I'm looking at what the majority of stocks are doing, and these are much bigger indices. What we did see this week was more panic than the prior week, and where you can see that stress is in correlations breaking. So this is a 5-minute chart of the week, S&P 500 in yellow, gold, and in blue TLT. These are assets that I would expect to be soaring higher when the market's selling off, and they have been for the most part until recently. So what that means is correlations are breaking. Investors, big funds are dumping everything. That means they're dumping gold, they're dumping bonds, they're dumping crude oil, they're dumping stocks. They're even dropping Bitcoin. I think Bitcoin had the worst week in almost 7 years. Dropping everything to get into one asset. That one asset is the US dollar. So here's UUP, the ETF for the US dollar. This is a daily chart, so this is the last 4 days. There is incredible demand for dollars, for liquidity, US dollars. You can view this as investors going to cash. That is the biggest weekly gain since Lehman Brothers during the financial crisis. So you can see the same kind of dynamics are playing out. And that's why you see these weird moves, like treasuries being down while stocks are down, or gold being down while the market's getting killed. And when you have a move like this in the US dollar, I think it's going to weigh on gold, although gold's been acting weird around 1700 for a couple weeks. And you can see that here too. A diversified book of stocks and bonds just had its worst week since Lehman Brothers, since the financial crisis. And these risk parity funds, like one of Ray Dalio's Bridgewater's global macro funds, this is the risk parity funds just dropping everything. Doesn't matter if they like it or not, they're getting into cash, getting out of any kind of asset, whether it's safe haven or not. Here's the FRA OIS spread just blowing out. This is a closely watched indicator of interbank dollar liquidity stress. And that's what you're really seeing this week, is a lot of people panicking. Here's the spread in red, and here's the dollar in blue for this past week, actually on the 13th. And again, we're seeing actions like Boeing. And you remember this chart with Boeing when they fired the CEO, but it's still back-tested under this triangle, year-long triangle. Back-tested, broke down 35% on the week. They're drawing down a $14 billion revolver. So this is the kind of funding stresses that we're seeing pop up. These are like the second, third order effects that people are not grasping, or were not grasping, and starting to come to terms with this past week. Pay attention to credit. High yield credit just got smashed. That's because of all these energy companies that are now caught in the middle of this price war, the shale drillers here in the US, that basically I think their break-even price is around $50 a barrel of oil. So you're probably going to see bailouts for that industry, or a lot of talk of bailouts, but they have a lot of junk debt. So we saw high yield credit get crushed. And last week, investment grade credit had held up. That is not the case this week. Blasted right through that 50-day moving average where it had held through the 200-day. Crude oil down some 20% this week, that Saudi OPEC price war. This was one of the big warnings. Crude had already crashed while stocks were still at record highs. It had crashed 20%. Incredible. I mean, these are like 20% legs each. Here was my original target for USO, for crude, coming into this week. And of course, since that price war started, blew right through that. And this is how we ended the week. So this is a bearish descending triangle. Although prices did break out at the very end of Friday after President Trump held that press conference in which he announced that they're going to be filling the Strategic Petroleum Reserve. So that is presumably going to help out the shale producers to get some oil sold. So gold's another one. Just got dumped this week, I think down about 9%. You can see how bullish this has been. I mean, even though they've been 4 or 5 month consolidations, they've been very, very bullish. This price trend has been very bullish. This is another one of the warnings over the last year that something was coming. TLT, the same thing, had a chart almost exactly the same as this. But if we take a look at this last week or two, gold's volatility is starting to look like stocks volatility. I believe most of the reason for this is that investors are selling everything going to cash. But there can be other reasons. We saw some selling up here around 1700, which was the upside target for this leg. So we did meet that over here. This is just some of the unanticipated kind of effects of what we're going through right now with the sell-off. So I was hoping that it would hold this trend line. I said if it didn't, I expected it to test 140 to 142. That's where it tested. So far, price has not shown any stability yet. Otherwise, I think we could pull all the way back to this trend line, about 132 for GLD, and still have a constructive uptrend. Right now, price action is way too volatile and is still bearish. You can see this decline, a little teeny consolidation. That's like a descending triangle like we just saw in crude. And another decline. This is kind of like a little small flag. There's just no stability there yet. By the way, some people ask me about Bitcoin or GBTC. I don't follow Bitcoin. I don't know anything about it. Just looking at this trend, though, I would say that it's worth a look down here around $5 for GBTC. Gold miners just smashed this week with gold. Remember that they do have a correlation with gold, but these are still stocks, and people want out of stocks right now. So I think this was a 35% decline. This is an area that I will be interested in as this recession, and I am saying recession, unfolds. But at this point, people are just fleeing anything that's equity. So of course the question on everybody's mind is, where is the bottom? When is this going to stop? We've never seen anything like this. Earlier this week, I said if the Dow acts like crude did, then it should hit the bottom of this broadening formation. Remember, this broadening formation we've seen since basically 2018. Little did I know that the Dow, from the point I said that early in the week, made it more than halfway there over the next 2 days. I think price does go here. I don't think that's a bottom. I just think it does go to this point, and we'll probably see some kind of bounce off that. But that's not at all a forecast of where I think this market eventually ends up. I think you have to be really careful with what people are saying out there, because I watched CNBC again this week, and same stuff. If the market is up, that one day if it's green, everybody's talking about, is this the low? Where's the bottom? We think stocks are a great value here. How could you possibly know? Because you have the P, you don't have the E. You have no idea what earnings are going to be. I mean, look at some of this craziness. Kudlow saying that it's basically contained and that stocks are interesting here, or buy stocks here, something like that. And I've never seen officials from Washington pump the stock market. I've never seen that. It's just unreal. The coronavirus is very much under control in the U.S. Stock market is starting to look very good to me. And here's Eric Trump. In my opinion, it's a great time to buy stocks in your 401k. I would be all in. Let's see if I'm right. You were wrong, Eric. We saw a 16% decline from there. A lot of guests on CNBC and Drawdown Josh Brown are asking, who could have seen this coming? For one, the virus is named COVID-19 for the year 2019. It was out there in 2019. This is one of my videos from December 8th, Volatility rumbling. VIX is up 500%, more than 500% from there. I posted this video literally entitled Coronavirus Black Swan. This is February 1st, 6 weeks ago. And that was literally right there. On February 21st, before the sell-off started, this is the intro to my video. I would be remiss really for not getting to the heart of the issue, which is the macro environment and the signals that are being sent by the bond market, the currency market, the commodity market. And what they're all screaming, not warning, but screaming, is that this coronavirus is a big deal. It's not contained, and they're screaming that there's a lot more to go on the downside. So I'm not saying, hey, look, victory lap. It's not about that. It was the bond market, it was the currency market, and it was the commodity market all screaming way back here that this was coming, that something really bad was coming. So I'm not saying the average investor should have known this, but the people who manage money and the people who risk manage money that populate CNBC set, they should have known. And this was just the public video I had out, so believe me, my subscribers were hearing this for a while, and I'm sure they were sick of it. Whether or not they made money or not, they didn't lose this kind of money. I don't usually do a lot of opinion kind of stuff on my videos or with my subscribers. I offer what I see on charts that's concrete, that you can pull up on a chart for yourself, and then you can decide, is this relevant to me or not? It's your risk, your reward. But I think it's worth taking a moment and just looking at kind of where we are, where we were, to get an idea of where we may be going. We were already end cycle. We were already heading to at least a garden variety recession. But in this case, it's not just late cycle, is it? All this volatility, that's about the trade war. So not only are we late cycle, we have a trade war, we have tariffs, we have global supply chains fracturing due to this. You have a massive rally, more than 40% on zero earnings growth. Then you add a black swan like coronavirus, where we have no visibility. Does this reaction that didn't even retrace the entire rally look unreasonable? Add to that another black swan crashing into that black swan, which is the price war in oil going on, started by Saudi Arabia this past week. Think about what that does to the jobs of millions of people who work in the shale patch here in the US. We have a rolling shutdown of global economies that we're seeing play out before our eyes. Italy has closed every business in the country. There's zero economic output from that country. We're closing our borders here in the US, but even beyond that, within our borders, people are closing off into their homes, and they will be on an increasingly frequent basis. We have an unprecedented demand and supply shock at the same time. Even during the World War, people were going out buying things. Goods were still being produced. We already had a manufacturing recession underway in the US, and the consumer was what kept the whole economy out of recession. Right now, the consumer is the Achilles heel, and that's 70% of the US economy. So historically, your typical recession, garden variety recession in the US has seen the stock market decline 30 to 40%. Bad recessions, like the financial crisis in 2008, you're looking like 40 to 60%. The S&P lost 50% after the dot-com bubble. Really wasn't a bad recession at all. NASDAQ lost over 80%. A depression is on the order of 60 to 80%. 1929 and the following depression, the Dow lost 90%. As of Friday's close, the S&P 500 is 20% off its record highs. Without exaggeration, I think it's safe to say we could be facing the worst economic crisis of our lives. I could be wrong. I hope I'm wrong. But these are the conversations that you're not hearing elsewhere right now. I hope it's not the case. I really do, because I can make money either way, long or short. I hope it's not the case. But when you have these clowns that didn't see this in the first place telling you now that everything is going to be fine and it's going to be a V-shaped recovery, you have to think twice. What about the central banks? Are they going to save us? I have to tell you, historically speaking, at this point in the economic cycle, central banks are impotent. Here's QQQ from the 2000 top, the dot-com bubble. And remember, this wasn't so much a recession hitting the stock market as it was valuations being insanely crazy and the stock market rolling over, putting the US economy into recession. And pretty mild one, actually. Here are my notes. These are policy actions that the Fed took. Let me zoom in a little bit closer. 50 basis point cut, 50 basis point cut, 50, 50, 50, 25, 50, 25, 50, 50, 50, 50, 25, 50. That's the point I'm trying to get across. Don't expect what you've seen over the last 10 years to be what happens going forward. Here's the S&P 500 from the financial crisis. Discount rate cut, 50 basis points, 25 basis points, 75, 50, 25, 75, Lehman collapses, 50, 50, 75 to 100, taking the Fed's funds rate down to zero. And during this, we had all kinds of economic stimulus as well, like that TARP we just looked at. So moving forward, my downside targets for measured moves have been hit. That doesn't mean it's over and we rally. It means it's a good place for the market to stop and reassess. Sometimes that will be in the form of a bounce or correction. Sometimes that will be in the form of a consolidation, like another bear flag. I kind of lean toward this TARP type scenario. And that's what we actually saw was the worst week since this week over here, and Friday the best day since TARP. I kind of favor a scenario like this where we get maybe a week-long or so bounce. Suckers rally, in my opinion, suckers rally, that's where I want to short. To get in size, I want to see a decent rally. I want to see people dismissing this as an overreaction, feeling confident again, talking about, the V-shaped recovery. That's the kind of stuff I want to see to get back in short. When this turned, and it did turn, we lost another 35% from here. One of the things that happened right here was bond yields, which are bouncing right now with stocks this past week because bonds are getting sold off. Bond yields turned down. They called the end of this bounce. So if we do get a bounce over the next week or so, you'll want to watch those. I mean, the bond yields, the commodities, the currencies, they've been the ones telling us that something bad was coming. Remember, we also have the FOMC next Wednesday, and they are expected to cut rates sharply, potentially bring them down to zero. As far as a target, looking at prior sucker rallies and how much they've moved, I would kind of lean towards something between 28.25 and 2900. I would get real excited about shorting the market over 3,000, maybe up to this blue 200-day moving average at 30.50. I'm not opposed to trading the market on the long side, but because this trend is down, I feel much more confident in selling the rips than buying the dips. So I don't know when or where I'll make that pivot and become a seller. It's not really my job to predict the market. These targets that I put out on Sunday night and that the market hit Friday, a week later, these aren't predictions. I have a rational process of why I came up with that number. And as price action changed midweek with this little flag, I adjusted to it. So I know that's a lot of information, not a lot of conclusions, but if you have the information, you're way ahead. So with that, I'm going to wrap this up. I know it's a really long video. If you did like it, please give it a thumbs up. Feel free to share it with people that you think might get something out of it. And if you have questions or comments, like always, great stuff. Actually, the last couple of weeks, I really appreciate all the comments, questions, views. Just go ahead and leave those in the comment section below. You can also follow me on Twitter. And if you're interested in subscribing, there is a link in the description of this video to the website, and you can check that out. So everybody, have a fantastic weekend. Members, as always, I'll see you on Monday, but if anything happens big on Sunday night with the futures, like last Sunday, I put out all those targets, I will let you know. I will put out a post if I see something that looks relevant.